3 weeks ago, I made a decision that most investors would call reckless. I cut my Nvidia holdings in half. Not because I've lost faith in AI, not because I think Nvidia is finished, but because history is signaling something most people aren't paying attention to yet. And if historical market cycles are any guide, we could be standing at the beginning of another massive wealth shift inside the AI revolution. Not in the obvious companies, not in the names dominating financial headlines, but in 3 infrastructure businesses quietly locking in multi-billion-dollar agreements, while public attention remains focused elsewhere. If you ignore what I'm about to explain, you're not just risking missing profits, you may miss the kind of opportunity that only appears a handful of times in an investing lifetime. Later in this presentation, I'm going to reveal one partnership involving Nvidia that changes how risk in this opportunity might be viewed. Most investors are completely unaware of it, but you need to understand the bigger pattern first, or that detail won't make sense. What I'm about to explain comes from investment frameworks developed by Dalio, principles refined across 5 decades of studying global market cycles. These frameworks helped identify structural vulnerabilities before the 2008 financial crisis. They helped track technological adoption waves long before they became obvious. And they helped build one of the largest hedge funds in history, Bridgewater Associates, which at one point managed well over $100 billion. These principles are not based on hype or short-term speculation. They focus on recurring patterns in how capital flows during technological transformation. According to those patterns, artificial intelligence is entering a stage that historically produces some of the largest asymmetric wealth opportunities. But most investors are watching the wrong layer of the market. Before continuing, understand this is educational analysis using publicly available company data, earnings reports, and industry trends. I'm not affiliated with Dalio or Bridgewater. I'm not a licensed financial advisor. Always perform your own research and consult qualified professionals before making investment decisions. Now let me explain why this matters using a real-world type of scenario. Consider someone we'll call Michael. Michael spent over 30 years working as a systems engineer. By 2020, he had built a solid retirement portfolio worth around $550,000. He was financially responsible, disciplined, and on track to retire comfortably. Around that time, Michael began hearing about a semiconductor company becoming critical to artificial intelligence development. The stock price looked high compared to historical valuations. Michael hesitated. He told himself the technology was too complex to understand. He wanted more confirmation. He wanted analysts, media coverage, and public consensus before making a decision. So he waited. While he waited, the company's valuation multiplied several times over. A relatively small investment he considered could have significantly accelerated his retirement timeline. Today, Michael continues working, not because he wants to, but because hesitation delayed his financial flexibility. And the real loss wasn't just money, it was time. Time is the one resource markets never return once it's gone. Right now, the market may be forming another moment where hesitation quietly becomes expensive. Throughout history, nearly every major technological revolution has created 3 predictable layers of wealth creation. This pattern has repeated across industries for more than a century. The first layer includes innovation creators, companies designing the core breakthrough technology. In artificial intelligence, this includes chip manufacturers and foundational AI model developers. Investors who enter early in this phase often see explosive growth. However, by the time mainstream investors recognize these companies, much of the exponential upside is usually already realized. The second layer involves infrastructure builders, the companies constructing the ecosystem that allows innovation to scale globally. These businesses build data centers, networking architecture, cloud systems, and power distribution capabilities. Historically, this phase often produces extraordinary investment opportunities because infrastructure becomes the bottleneck that every participant in the industry depends on. The third layer involves consumer and enterprise applications. This is when mainstream adoption accelerates, public excitement peaks, and retail investment floods the market. Returns during this phase often become more moderate. This pattern repeated during the internet expansion. Early computing and operating system companies represented the first layer. Networking infrastructure companies formed the second layer, enabling global internet connectivity. Consumer internet startups formed the third layer, many of which failed when the hype exceeded business fundamentals. Infrastructure providers repeatedly captured enormous value because they became essential to the entire ecosystem. Today, artificial intelligence appears to be transitioning from the first layer into the infrastructure expansion phase. Within this infrastructure phase, Three companies are positioning themselves as essential toll roads for artificial intelligence growth, businesses that generate revenue every time AI demand increases. One of them has a partnership structure that may create an unusual safety net backed by Nvidia itself. To understand that, you first need to examine each company's strategic role. These companies don't compete directly with Nvidia. They monetize Nvidia's technology by providing the environments where its hardware operates at scale. Institutional capital appears to be flowing toward these infrastructure providers quietly. The first company is CoreWeave. CoreWeave operates an expanding network of AI-focused data centers across North America and Europe. Industry reports suggest the company manages hundreds of thousands of advanced GPUs, many supplied by Nvidia, and controls massive contracted power capacity, one of the scarcest resources in AI infrastructure. Power availability is critical because next-generation AI servers consume enormous energy. Without sufficient energy and cooling infrastructure, AI expansion slows dramatically. CoreWeave has recently reported substantial revenue growth and accumulated tens of billions of dollars in contracted future revenue commitments. Several major global technology firms have reportedly signed long-term agreements with the company. What makes CoreWeave especially notable is its reported strategic relationship with Nvidia. Nvidia has reportedly invested directly into the company and structured partnership agreements that may involve purchasing unused computing capacity under certain circumstances. This suggests that the world's leading AI chip manufacturer is not only supplying hardware, but is strategically aligned with an infrastructure partner expanding its deployment footprint. That level of vertical integration is uncommon and strategically significant. The second company is Nebius. Nebius is smaller but has reported extremely rapid growth. Its strategy focuses on sovereign AI infrastructure, building AI computing environments that comply with strict regulatory, privacy, and data security requirements for governments, healthcare systems, and financial institutions. Many of these sectors cannot use traditional public cloud providers due to data sovereignty laws. By targeting high-regulation industries early, Nebius may be following a trust-first expansion model similar to companies that build early relationships with national defense and intelligence organizations before expanding into broader commercial markets. Nebius is aggressively expanding energy capacity and reportedly securing long-term enterprise agreements. The opportunity carries higher volatility, but may present significant upside if execution continues. The third company is IREN. IREN offers a hybrid infrastructure model. The company initially built large-scale energy infrastructure for digital asset mining, but began reallocating energy capacity toward artificial intelligence workloads when AI computing became economically superior. Reports indicate the company has secured large multi-year infrastructure agreements involving advanced GPU deployment. IREN's distinguishing advantage is operational flexibility. If AI demand fluctuates, the company retains the ability to redirect energy capacity toward alternative high-performance computing workloads. This optionality may provide built-in risk mitigation compared to infrastructure companies focused solely on AI deployment. Some investors may question whether artificial intelligence investments are already overpriced, or whether infrastructure carries excessive risk. These concerns are valid. However, infrastructure providers often benefit from long-term contracted revenue models and predictable demand visibility once deployment cycles begin. Volatility is another common concern. Emerging infrastructure companies frequently experience price swings. Historically, volatility has often been the entry cost for accessing asymmetric growth opportunities. The larger risk historically has been waiting until uncertainty disappears, because by then, most of the exponential upside has already occurred. Every technological wealth transfer tends to separate investors into two groups: those who recognize structural change early, even when it feels uncertain, and those who wait for universal validation and unknowingly finance early adopters. The difference rarely comes down to intelligence. It usually comes down to timing and conviction. If historical technology cycles repeat, artificial intelligence infrastructure demand may accelerate significantly over the next several years as enterprises, governments, and entire industries deploy AI at scale. When public awareness fully catches up, infrastructure capacity providers often experience rapid repricing. That transition window historically lasts a limited period, often only a few years before growth stabilizes. This is not a recommendation to purchase any specific investment. It is an invitation to investigate. Study earnings reports, examine contract disclosures, analyze infrastructure demand forecasts. Evaluate whether these companies align with your investment goals and risk tolerance, because doing nothing is still a decision. History shows that ignoring early infrastructure phases of technological revolutions has cost investors more opportunities than almost any other mistake. If this analysis helped you understand market patterns differently, consider following this channel. The focus here is long-cycle structural transformation. Not hype, not headlines, just recurring patterns in how innovation redistributes wealth. If historical cycles continue to rhyme, the AI infrastructure phase may only be beginning. I'll see you in the next analysis.